Hi everyone, today we're tackling a complex but crucial topic for anyone who has left or is planning to leave Canada: managing your Canadian source income as a non-resident. It might seem like once you're gone, your Canadian tax worries are over, but that's often not the case. Let's break down all the potential ongoing tax obligations once you have left Canada. First of all, let's discuss what it means to be a non-resident. It's important to understand that when we talk about residency in a tax context, it's not quite the same as simply where you physically live. While your physical residence is where you spend most of your time, tax residency determines which country has a primary right to tax your worldwide income. A non-resident of Canada, for tax purposes, is someone who the Canada Revenue Agency no longer considers to have significant residential ties to Canada. This means they've severed or significantly reduced their connections to the country to the point where Canada no longer has the primary right to tax their income earned anywhere in the world. To learn more about the process of becoming a non-resident, watch my video, Tax Implications of Leaving Canada, Non-Resident Status and Departure Tax Explained, Part 1, and Leaving Canada Permanently, 7 Essential Tax Tips for Non-Residency, Part 2. However, even after becoming a non-resident, you may still have an obligation to submit tax documents and even pay taxes. Let's talk about what these are. Okay, so what exactly is Canadian source income? It's any income that comes from Canada, even if you're living abroad. This includes the following: pensions, such as the Canada Pension Plan, old age security or private pensions, rental income from Canadian properties, dividends from Canadian corporations, interest income from Canadian investments, employment income earned in Canada, self-employment income from doing business in Canada, real estate sales after you leave Canada. All of those income sources trigger what is called a withholding tax for those who are not considered tax residents of Canada. When you earn Canadian source income, the person or company paying you often has to deduct a certain amount of tax and send it directly to the CRA. This is called withholding tax. Think of it like income tax being taken off your paycheck. The default withholding tax rate is usually 25%. However, this can change depending on the type of income and whether Canada has a tax treaty with your new country of residence. The good news is there are ways to minimize your Canadian tax burden as a non-resident. For each income source, there are forms and applications you can make to the CRA to limit your tax liability. Let's go over each of these. For pensions, you can use Form NR5 or Section 217 to reduce the tax withheld. The NR5 is an application by a non-resident of Canada for a reduction in the amount of non-resident tax required to be withheld for the tax year. This allows you to reduce the amount of taxes deducted right at the source, for example, from 25% to 15%, depending on the tax treaty Canada has with your country of residence. If you didn't submit Form NR5 to the CRA, don't worry. You can still obtain a refund of the tax withheld by electing under Section 217 of the Canadian Income Tax Act. Section 217 allows non-residents to elect to file a Canadian Personal Income Tax Return, T1, as if they were residents, but only for specific types of income, such as old age security, CPP benefits, RRSP payments, and RIF payments. This election can be advantageous if the tax calculated under Section 217 is less than the withholding tax, usually 25%, that would otherwise apply. As a non-resident of Canada earning rental income from Canadian property, you are required to remit a 25% withholding tax on the gross rental income collected each month. The amount must be remitted to the Canada Revenue Agency by the 15th day of the following month. However, there are options available to reduce or recover the tax withheld at source. One option is to file a Section 216 return, Form T1159, after the end of the calendar year. This optional return allows you to report your rental income on a net basis, deducting eligible expenses such as mortgage interest, property taxes, insurance, utilities, maintenance, and management fees. The net rental income is then taxed at a rate of 22%. Any tax withheld in excess of the actual tax payable will be refunded to you upon assessment of your Section 216 return. An alternative approach is to submit Form NR6 to the CRA before the start of each calendar year. If approved, this form permits a reduction of the monthly withholding tax from 25% of the gross rental income to 25% of the estimated net rental income after expenses. This improves your monthly cash flow by reducing the amount of tax withheld at source. However, to use this method, you must appoint a Canadian resident to act as your agent. The agent is responsible for filing an NR4 summary and slips with the CRA by March 31st of the following year, and for remitting the appropriate tax each month. Regardless of whether Form NR6 is filed, you must still file a Section 216 return after the year end to calculate your actual tax liability based on the actual rental income and expenses. The CRA will issue a refund for any overpaid tax or require payment of any shortfall. For dividends from Canadian corporations, both public and private, you might be able to reduce the withholding rate if there's a tax treaty with your new country of residence. For example, the Canada-US tax treaty reduces this amount from 25% to 15%. To claim the reduced amount, file Form NR301, the Declaration of Eligibility for Benefits under a Tax Treaty for a non-resident person, with the brokerage or financial institution where the dividends are received through. Interest income such as GICs or bonds may be exempt from withholding tax if the lender is a third party, meaning not a relative, and the non-resident reports the interest income in their home country without filing a Canadian tax return. If a reduction or exemption is desired, Form NR301 should be filed with the bank or financial institution. If you are employed by a foreign company to temporarily work in Canada, your company must comply with Canadian payroll obligations, including deducting Canadian income tax, CPP, and EI premiums from your paychecks. However, this may be avoided if a Regulation 102 waiver is obtained from the CRA. Consult with your employer to make sure your tax obligations are met. In the case where you are not a Canadian tax resident but come to Canada to perform a service, you are obligated to pay a withholding tax. For example, the Canadian company that pays the self-employed individual will withhold 15% from the invoice under Regulation 105 of the Canadian Income Tax Act. While 15% is the standard withholding tax rate for non-resident self-employed individuals, the tax rate for artists and athletes is 23%. Self-employed individuals can claim a refund of the tax withheld if they do not have a permanent establishment in Canada and they file a T1 non-resident tax return. Lastly, let's look at selling real estate as a non-resident. When a non-resident sells Canadian real estate, the buyer's attorney holds back 25% of the gross sales proceeds. To obtain a refund, the non-resident must apply for a certificate of compliance from the CRA, which can take up to a year to be issued. With this application, you will have to make a payment of capital gains tax based on the profit of 25%. Once you receive the certificate of compliance, you will send a copy to the buyer's lawyer to get the holdback released. Finally, you can file a Section 116 non-resident tax return to get a partial refund on the capital gains tax paid. For non-residents who choose to retain ownership of their Canadian corporation after leaving the country, it is strongly recommended to work with a local Canadian accountant to ensure ongoing compliance with all tax obligations. Upon becoming a non-resident of Canada, the status of your corporation will change from a Canadian-controlled private corporation, CCPC, to a non-CCPC as of the date your residency changes. This change has significant tax implications. Firstly, the corporate income tax rate increases substantially from 12% for CCPCs to approximately 26% for non-CCPCs on active business income. Secondly, any dividends paid from the corporation to you as a non-resident shareholder will be subject to a 25% withholding tax unless a lower rate applies under a tax treaty between Canada and your country of residence. These combined tax increases can significantly reduce the after-tax profits of your corporation and the dividends you receive. Therefore, it is important to carefully consider whether maintaining a Canadian corporation is beneficial after becoming a non-resident, and to plan accordingly with professional guidance. I know this sounds like a lot of information, and it is. The key takeaway is that you need to be proactive and understand your obligations. "I didn't know" is never an acceptable answer for the CRA. This is a complex area of taxes, and this video is just an overview. Be sure to consult with a qualified tax professional for personalized advice. Thank you for watching. If you found this helpful, please like and subscribe. And if you have any questions, leave a comment below. We're here to help you navigate the world of taxes.